Brian, we all know that RMDs, you take them at age 72 and you're taxed on that. But can I donate my RMD to a charity, and how does the tax situation work there?
Yeah, actually you can. The required minimum distribution is now age 72, and that's where the IRS, they want to get some taxes from you. And you have a big IRA account and you're saying, well, I don't really need the money, and so it just sits there. So the IRS passed these rules saying, no, we need some taxation, so we're going to require that you take a minimum distribution from that every year. So a lot of people say, well, I don't need the money and I don't really want to move it from my left pocket to my right pocket and just pay a bunch of tax. So what else can we do about that? Well, one of the techniques is to use this strategy through charities. And you can make a direct donation from your IRA account directly to the charity at your required minimum distribution amount or more, up to $100,000 a year per person you can do this with. Donate money directly from an IRA to that charity and not pay the income tax. Because all along you have this IRA account, you know you're going to pay the income tax on it someday at whatever the rates are for in the future for your income taxes. But here's a way around that where you can benefit, not only benefit your charity, but satisfy your required minimum distribution and not pay any income tax.
Brian, who is this strategy best suited for?
Yeah, this is best suited for somebody that does have a charitable intent, because otherwise, you're not going to give the charity money. You just take the required minimum distribution, pay the tax, and then it's yours to spend on yourself. But if you have enough assets, enough cash flow, and you have a charitable intent, then you'll want to consider this. Much like we talked in another video about donating appreciated assets, like appreciated stock and real estate, give it directly to the charity and not pay the income tax on that instead of selling it, paying the tax, and giving the charity what's left. This is another example of that, where you can give it directly, your IRA, because you're forced to do this anyway, so that it's a little different. You're not forced to sell your stocks and real estate in the other example. But in this, you're going to be forced to take money out. If you don't need it, you might as well go ahead and bypass the government, the IRS in this case, and give that money directly to that charity.
So tax savings are a big consideration here. Are there any reasons why someone would not want to do this particular strategy?
Well, not if they have that charitable intent and they have the extra money, because not only to give go further with this, that not only do you not pay tax on the donated amount up to $100,000, as I mentioned, but you also don't have a higher taxable income on your tax return itself. When you have a higher taxable income, often you start to get phased out of itemized deductions. Your Medicare premiums might go up. More of your Social Security might be taxed. There's a lot of other things on your tax return waiting for a higher adjusted gross income number to kick into play to raise your tax rate on your other income. Not only do you not pay tax on the gains from the IRA, the transfer from the IRA, but you prevent all these other negative things from happening.
Brian, do you have a lot of clients who've used this strategy? Do you have an example?
Oh yeah. So if you think about an example of somebody that's thinking about giving money to charity, and just to put some numbers with it, let's say $100,000, and they're in the 32% bracket, they could sell take the money out of their IRA and net $68,000 and give the charity $68,000. Okay, that's one thing, and now their taxable income's higher, as I mentioned. Or give the $100,000 directly and know that the charity's getting $100,000. Charities don't pay income tax on appreciated property or IRA money, and so it's a way to benefit yourself, your gifting strategy, and it does satisfy your required minimum distribution. So just to put some numbers with it, those are big numbers, and if you can benefit your charity an extra 32% or 24 or 22%, whatever your tax bracket is at that time, because remember, if you are taking a required minimum distribution, that's taxed at your highest marginal tax bracket, not your average tax bracket, your highest. So we're taking that money from your highest bracket and putting it directly to the charity.
Sounds like a very good gifting strategy. Brian, thanks for telling us more about that.